Have you ever wondered why you keep losing money in the market, even when you think you're making smart moves? Well, the problem isn't your strategy, it's your brain. Welcome back. Today, we're diving deep into the fascinating world of behavioral finance. You see, we all like to think we're rational investors, making logical decisions based on data and analysis. But the truth is, our brains are wired with certain cognitive biases that often lead us astray without us even realizing it. These biases can cause us to buy high, sell low, and make all sorts of financial blunders. By understanding these 5 common biases, you can start recognizing them in your own behavior and take steps to avoid costly mistakes. So, let's get started on this journey to smarter investing. Imagine this: you've done your research, you're confident in a stock, and you invest a significant chunk of your savings. But then, the market dips, and you panic. You sell at a loss, vowing to never invest again. Or maybe you see a hot tip on social media about a cryptocurrency that's about to explode. You jump in without doing your own research, only to watch it crash. Sound familiar? These scenarios are classic examples of cognitive biases at work. The first bias is loss aversion. Psychologically, losses hurt twice as much as gains feel good. This asymmetry makes us overly cautious and prone to selling winners too early and holding losers too long, hoping they'll bounce back. Another bias is confirmation bias, where we seek out information that supports our existing beliefs and ignore evidence that contradicts them. This can lead to a false sense of security and poor decision-making. And then there's overconfidence bias. We tend to overestimate our knowledge and ability to predict market movements, leading to excessive trading and unnecessary risks. These biases, among others, are the silent saboteurs of your portfolio. Let's dive deeper into each bias. Loss aversion, first discovered by psychologists Daniel Kahneman and Amos Tversky, is a powerful force. It explains why investors often hold on to losing stocks for too long, hoping to break even, while selling winning stocks too quickly to lock in gains. This behavior, known as the disposition effect, can significantly reduce your returns over time. To overcome loss aversion, set clear rules for when to sell a stock, based on your initial investment thesis, not on emotional reactions to price movements. Next, confirmation bias is rampant in the age of social media. When you're bullish on a stock, you tend to follow accounts that share your view and ignore bearish analyses. This creates an echo chamber that reinforces your beliefs, even if they're wrong. To combat this, actively seek out contrary opinions and consider the bear case before making any investment. Overconfidence bias is also widespread, especially among new investors who've experienced recent success. The market has a way of humbling even the most seasoned traders. Remember that past performance is not indicative of future results. Always do your due diligence and consider the risks. Another bias is herd mentality. When you see everyone buying a particular stock or cryptocurrency, you feel compelled to join in, fearing you'll miss out. This is the classic FOMO, fear of missing out behavior. It leads to buying at the top of a bubble and selling at the bottom of a crash. To resist this, stick to your investment plan and avoid making impulsive decisions based on others' actions. Lastly, anchoring bias is when we rely too heavily on the first piece of information we receive, like the initial price we paid for a stock. This anchor prevents us from adjusting our valuation as new information emerges. To avoid anchoring, focus on the fundamentals and regularly reassess your holdings based on current data. So, how do we overcome these biases? The first step is awareness. By simply knowing about these biases, you can start catching yourself when you're about to make an irrational decision. The next step is to develop a systematic investment plan and stick to it. This means setting clear goals, defining your risk tolerance, and establishing rules for buying and selling. For instance, you might decide to rebalance your portfolio quarterly, or to sell a stock if it drops more than 20% from your purchase price, regardless of your emotional attachment. Another effective strategy is to automate your investments. By setting up automatic contributions to a diversified portfolio, you remove the temptation to time the market or make emotional decisions. Additionally, consider working with a financial advisor or using robo-advisors that follow algorithmic strategies, which are not influenced by emotions. Finally, practice mindfulness and self-reflection. Before making any investment, ask yourself, am I buying this because of solid research, or because I'm afraid of missing out? Am I selling because the fundamentals have changed, or because I'm scared? Taking a step back can help you make more rational choices. In conclusion, understanding these 5 cognitive biases: loss aversion, confirmation bias, overconfidence bias, herd mentality, and anchoring bias is crucial for any investor. They can silently wreak havoc on your portfolio, but with awareness and discipline, you can overcome them. Remember, successful investing is not just about numbers, it's about managing your psychology. So, the next time you feel the urge to make a quick trade, pause and ask yourself if a bias is at play. If you found this video helpful, please give it a thumbs up and subscribe for more insights into investing psychology. And don't forget to hit the notification bell so you never miss an update. Thanks for watching, and here's to making smarter financial decisions.